Hello everybody, welcome to the March 27th through 28th, Thursday and Friday price action review. So getting started, we're looking at the S&P on the left and the NASDAQ on the right on the 4-hour time frame. And as you all know, I said we had this range high right here and this range low, and I said depending on which side we break out, that will tell us whether or not we will continue higher and go for those way higher targets that we had marked out, or if we break out below these lows, then we will likely deliver these lows. And as you can see, the NASDAQ being the weakest pair broke below this low, and now its next draw on liquidity are these lows right here. And another thing I specifically highlighted a little bit later on into the stream was this 4-hour fair value gap. And I said depending whether or not we see a cracking correlation at the bottom or the top within the fair value gap, depending whether or not we see a cracking correlation that sends price into this fair value gap, or we see a cracking correlation inside of that fair value gap that can give us insight. And we actually got both scenarios that played out, but the cracking correlation that formed within the gap ended up causing price to make the real run, and we will dive a little bit into that. So now going from the 4-hour time frame to the 1-hour time frame, we have the S&P on the left, the NASDAQ in the middle, and the Dow on the right. And I'm not sure why it doesn't have its little icon symbol right there, but we ended up forming a 1-hour TPD, which caused price to trade higher inside of that gap, running out these highs right here that were formed within that gap, and then price continued lower. Now I saw a lot of you took a long position from this 1-hour TPD and ended up catching some of this run right here, but the real move was to the short side. Now the reason this 1-hour TPD did not sustain price and allow for price to continue through this fair value gap is because, number one, this is a 4-hour fair value gap going against a 1-hour TPD that has no cracking correlation or no bearing supporting the idea. It's just the TPD in and of itself going against a 4-hour time frame. So with the weighted probabilities theory, a 4-hour fair value gap will override a 1-hour TPD. But there still must be a cracking correlation that forms within this 4-hour fair value gap, which is what we'll talk about. And another thing to add on to it is, I believe I said this previously in a live stream because I get a lot of questions in regards to this, but this big red shaded box is that 4-hour fair value gap, and then this small red shaded box within it is that 1-hour fair value gap. Whenever you have PD arrays that are in alignment like this, this is high probability. So as you can see, the NASDAQ repriced perfectly, closed inside of that fair value gap, and then completely rejected. So if you want to know where price is likely to take a stop at within higher time frame PD arrays, look for lower time frame gaps within a higher time frame gap, and that will kind of give you insight on how far or how deep price will retrace inside of a gap. But putting the Dow aside for a second, as we can see, this would be candle 2 right here with that TPD below the true opening price. And as you guys already know, we have this change in the state of delivery right here being this candle. So this candle closing above this candle's open. This is the lowest down close candle of candle number 2, viewing it through the lens of the 15-minute time frame. So this would be the reversion level. And as you all can see, especially the S&P tags right into the wick, price trades higher and runs for these highs. The NASDAQ tags into the body, hits it right to the tick, trades higher, runs lower one more time, tagging into only the wick, and then trades higher, going for these highs. Now these aren't just any highs. These are the original consolidation highs. And I don't have to outline this, majority of you guys already know, and if you don't know, just ask your fellow peers. But this would be the first phase accumulation, and then all of these highs right here would be that original consolidation, and especially these highs. So even though price delivered extremely bearish for the rest of the week, and this was a short-lived bullish run, even if you got it wrong and you made money from this trade, or you correctly identified this, then even though you were wrong, you were still right. And that's something you can write down, because there will be times in price where it'll offer a setup that is opposing to the higher time frame narrative, but it simply serves as a short-term retracement for something larger. Now, is this a viable trade? Absolutely, because as you guys know, I already tell you, target original consolidation highs from a reversion level. So this was still an A plus setup. So even if you took a partial above this high and was expecting higher prices, and it came back and rolled against you and hit you out at break even, that's still a winning trade, and that's still a winning day. So don't beat yourself up, don't go on tilt. You still did everything correctly, and you did everything perfectly fine. But looking a little bit more into these highs in specific that would act as the original consolidation highs, as you all can see, they are unsymmetrical, which is a reoccurring phenomenon that tends to happen with original consolidation highs and lows. So as you can see, these highs right here are higher than this high, while these highs right here are lower than this high. So this is unsymmetrical. Original consolidation highs or lows that are unsymmetrical add a little bit more probability to identifying a proper original consolidation. And adding on top of that, bringing the Dow back into the equation, the reason why price reversed after we took these highs is number one, yes, we had that imbalance, but the cracking correlation that solidified this imbalance was the SMT on the original consolidation highs. Although this wasn't sequential, this is still a high probability SMT, which was the catalyst for price dropping and continuing lower for the weekly range. So now going from a 15-minute chart to a 1-hour chart, as you can see, we drive higher, run out those highs, break down lower, and then stay a little bit lackluster and consolidative, but then we break through this low right here, which would be that TPD, trade back into it, treating it as a breaker, alongside with that forming a fair value gap. So we have a fair value gap and a breaker in alignment, which as you already know is high probability. Price retraces into that in the morning session and then drives lower to the lows of the range. Now, why is this a breaker? Because we have a low, higher high, trading above this high. Not just any high though. Break lower, lower low. So lower low, higher high, lower low again. This entire candle would be the breaker. Draw that across. We have a fair value gap in alignment. Price trades higher inside of the fair value gap and then creates the run. So Friday was a continuation of Thursday. Now bringing the Dow back into the equation, looking a little bit deeper inside of that fair value gap. As you all can see, before price really took off and created the run, within that fair value gap, once we repriced into there, we formed a TPD. So if we look at the Dow, this candle's opening price is higher than this close, while the NASDAQ and the S&P, this candle's opening price is lower than this candle's close, and the same thing for the S&P. And this TPD within the gap is what caused the morning session run and pretty much the entire expansion of the day. And whenever you're expecting continuation days, because as I said, Friday was a continuation of Thursday, that's when you're looking for higher time frame PD arrays to support price, and you don't necessarily need so much framework on the lower time frame. So with that being said, hopefully you all found this one insightful. I will speak with you all again on Sunday. Good luck and good trading.